I have to be honest with you. I made the mistake of checking my portfolio first thing this morning.
Oh, no!
You know that feeling? You open the app, and it's just a sea of red.
It's the breakfast of champions. Or, well, maybe the breakfast of anxiety.
Exactly. And I'm not the only one feeling it. I was scrolling through my inbox, checking the forums, and there's a very specific theme dominating the conversation right now.
Let me guess.
It all boils down to one panic-induced question. Is it too late?
Ah, the classic FOMO. Or in this case, maybe the fear that the floor is about to drop out.
It's a bit of both.
Yeah.
Specifically, everyone is asking, is it too late to buy SoFi stock?
Mm-hmm.
Because if you've been watching the charts, you've seen the price take a hit. It's been hovering in that $19 range, dipping down, bouncing back. I mean, it's volatile.
It is.
And I think a lot of people who bought in higher are looking at those red numbers and feeling, well, shaken.
It's completely understandable. Volatility is, it's uncomfortable. It triggers that fight or flight response in your brain.
Right.
But this is exactly where we have to take a deep breath, step back, and look at what's actually happening inside the business.
Separate the stock price from the company performance.
Exactly. And that is our mission for this deep dive. We are going to look past the mood swings of the market, what the ticker is doing on a random Tuesday, and look at the actual weight of the company.
Because the source material we're looking at today paints a picture that is honestly quite different from what the sentiment would suggest.
To frame this, I want to bring up a philosophy from Warren Buffett that the source material highlights.
Okay.
It's a concept that I think every investor needs, tattooed on their forearm. He says, in the short run, the market is a voting machine.
A voting machine.
Yeah. It's a popularity contest. It's driven by emotion, headlines, fear, greed. It's all about who is popular today.
Okay. But in the long run?
In the long run, the market is a weighing machine. Eventually, the substance of the company, its earnings, its assets, its efficiency, its cash flow, that is what determines the value.
So our job today is to ignore the voting machine for the next 15 minutes.
We are going to put SoFi on the scale.
I love that visual. Let's see how much this thing actually weighs. Because if the market is voting no, but the scale says heavy.
That's where the opportunity is, right?
Precisely.
Yeah.
That is the disconnect we are looking for.
Okay, let's unpack this. We have to start with the #1 indicator of a healthy business. The meat and potatoes.
Are they actually making money?
It sounds like such a basic question, but in fintech, it's often the most difficult one to answer.
Well, we have the latest quarterly data here, and there's one number that just jumps off the page. Adjusted EBITDA. For this single quarter, SoFi posted a record $318 million.
That is a massive number, but, numbers without context are just noise.
Right.
To understand the weight of that $318 million, you have to compare it to where they came from.
Right. So looking at the historical data, that single quarter, just 3 months, delivered nearly half of what the company generated in the entire year of 2024 combined.
Think about that. Think about the velocity of that change.
It's incredible.
When a company can generate in 3 months what used to take them 6 or 7, you aren't just looking at growth. You're looking at a fundamental shift in the engine of the business. It's an inflection point.
Oh, wait, I have to play devil's advocate here for a second.
Please do.
We hear about adjusted EBITDA all the time in tech. And sometimes it feels like, accounting gymnastics to hide the fact that they're actually losing money. Is this real profit?
Or is it just creative math?
Yeah.
That is a fair skepticism.
Yeah.
A lot of companies use adjusted metrics to hide things like stock-based compensation. But the source material highlights something critical here.
Which is?
A 9-quarter streak of GAAP profitability.
GAAP profitability. Okay, that's the strict standard, right?
Yeah.
Generally accepted accounting principles.
Correct. That is the gold standard. That means after you pay the employees, pay the electric bill, pay the stock compensation, and pay the taxes.
There's still money left over.
There is still money left over, and they've done that for 9 quarters in a row.
9 consecutive quarters.
Yes. In the world of high-growth fintech, that is incredibly rare. Anyone can have a lucky quarter where they, sell off an asset or slash marketing to zero to make the bottom line look good.
Sure.
But a 2-year streak, that implies operational discipline.
So it's not a fluke.
No. It signals that this profitability is structural. It's built into the way they do business now. So when we talk about weighing the company, this adds a lot of heft.
Okay.
This isn't a startup burning cash hoping to figure out how to make money someday. This is a profit-generating machine.
Okay, so the bank account looks good, But a bank is nothing without customers. Let's talk about the people side of this equation.
The user base,
Yeah.
or the member base, as they call it.
Right. The growth here is, well, it's aggressive.
Mm.
We're looking at a jump from 10.1 million members to 13.7 million members.
In just 1 year.
It's just 1 year.
If we break that down, that is roughly a 35–36% increase year over year.
Which is huge.
And here's why that matters. For a financial institution that's already at the scale of 10 million users, growing by another third is incredibly difficult.
Usually as you get bigger, you slow down.
Yeah.
The law of large numbers kicks in.
Of course. It's easier to double when you have 10 customers than when you have 10 million.
But they aren't slowing down.
No. The source says they are adding roughly 1 million new members every single quarter. That pace is it's relentless.
So let me ask you this. Are these real members? Or are these just people signing up for a free $50 and then deleting the app? Because 1 million hollow accounts doesn't add much weight to our scale.
That is the crucial question. And this is where the source material gets interesting. They don't just refer to it as a user list. They talk about an ecosystem.
The super app strategy.
Right. And this brings us to the flywheel effect. When SoFi acquires a customer, maybe they come in for a high-yield savings account because they saw an ad. That's the entry point.
Okay.
But once they're in the app, SoFi has data. They
Right.
know the income, the spending habits.
So they can say, hey, I see you're paying 7% on that student loan. We can refinance that for you.
Exactly. And because the customer is already verified and in the system, the cost to sell that second product, the student loan or the mortgage or the investment account, is near zero.
And that's the margin expansion we talked about earlier.
Yes. When you bring 1 million people into an ecosystem, you aren't just getting 1 million transaction fees.
You're getting 1 million potential mortgage customers.
Exactly. The cross-selling opportunity gets stronger with every single quarter. That is why the weight increases faster than the user count.
So we have record profits. We have millions of new people flooding into this ecosystem. If the business is doing so well, why is the stock price giving people heartburn?
Or maybe the better question is, if retail investors are panicking, who is actually buying at these prices?
Right. And this brings us to the smart money section of our analysis. This is often the most telling signal for retail investors who are feeling nervous.
Yeah.
The source highlighted a very specific time frame here. It says, institutional ownership recently surged.
It went from 54% to almost 58%.
Now, to a listener, a 4% jump might sound like a rounding error, but we need to put that in context.
We do. When we say institutional ownership, we're talking about the whales.
Hedge funds, pension funds, mutual funds.
Exactly. These are entities managing billions of dollars. They have teams of analysts who spend 40, 50 hours a week dissecting balance sheets, interviewing management, modeling risk.
They don't buy stocks on a whim because they saw a meme on Twitter.
They do not. So if they move the needle by 4%...
that represents hundreds of millions of dollars of capital flowing into the stock.
And the timeline is what really stood out to me. The source says this happened in a single week.
In a single week. Well, the stock was trading under $20.
While everyone else was panicking. That is the signal.
Okay.
When you see institutional ownership spike like that, specifically when the price is depressed, it means the smart money has modeled a floor. They're looking at that weighing machine and they see a massive discrepancy between the price tag and the value.
They see a bargain.
They are accumulating shares while the sentiment is shaky. It's almost like they're waiting for the rest of us to catch up.
Now, part of the reason these big players might be so bullish, despite the scary headlines, is the efficiency of the model itself.
Right.
The source makes a direct comparison to the old guard,
Yeah.
specifically mentioning Bank of America.
This is the classic legacy versus challenger comparison. And to understand it, I kind of like to use the Netflix versus Blockbuster analogy.
Okay, I'm listening.
Remember Blockbuster? They had stores on every corner. It was convenient, sure, but they had to pay rent, electricity, and staff for every single one of those locations.
Yeah.
That is a massive fixed cost.
And then Netflix comes along and just ships the DVD, or eventually streams it. No stores.
No overhead. Exactly. SoFi is the Netflix in this scenario. The source calls SoFi a lean, digital-first machine.
Unlike Bank of America, SoFi doesn't have thousands of physical branches.
It seems obvious, but let's look at the financial implications of that. If you're Bank of America, you are paying property tax on prime real estate in thousands of cities. You're paying to heat them in the winter, cool them in the summer. You need security guards, tellers.
Branch managers, all of it.
And SoFi has none of that. Zero. They don't have the massive debt associated with maintaining real estate, so every dollar of revenue they bring in has a much easier path to the bottom line.
Because it doesn't have to pay for the electric bill at a branch in Topeka.
It is a structural advantage, and this is why they can offer those high interest rates to savers, 4.5% or whatever it is today, which attracts those 1 million members a quarter.
They're passing their lack of overhead back to the customer.
Which a legacy bank literally cannot do.
Not without firing thousands of people and closing thousands of branches.
Right, which would be a PR nightmare and a logistical disaster. So, SoFi has a moat. It's a cost advantage moat.
So we've weighed the present, we've
Yep.
got the profits, the members, the lean model. But let's look forward.
Okay.
Because investing is about where the puck is going, not where it is. And honestly, this is where I start to get a little skeptical again.
How so?
Well, the management team has put out a forecast that goes all the way through 2028.
Mm-hmm.
And the numbers, they aren't small.
Oh,
They are projecting 38 to 42% annualized earnings growth.
that is a very bold number.
Bold. It sounds borderline impossible.
Oh, yeah.
40% growth every year for 4 years. In this economy, how are they justifying that?
It is an incredibly ambitious target. To sustain that kind of growth, everything has to go right. But the argument is that they are just now hitting that profitability inflection point we discussed earlier.
Right.
As the fixed costs stay low and the revenue grows, the earnings they explode upwards.
Okay, so that's the math. But are there any catalysts that could actually make that happen? The source mentions 2 big events on the horizon. First up, potential S&P 500 inclusion.
This would be a major milestone. Getting added to the S&P 500 is like getting the ultimate seal of approval from Wall Street. But more importantly, it triggers a mechanical chain reaction.
The index effect.
Exactly. Think about all the passive money in the world. Your 401k, pension funds, these massive ETFs that just blindly track the S&P 500.
They don't pick stocks, they just buy the list.
Right. So if SoFi gets added to the list, all those funds must buy SoFi stock. They have no choice. It creates a massive guaranteed wave of demand for the shares.
And that buying pressure alone can drive the stock price up significantly.
Huge potential tailwind.
Okay, so that's one. But there's another one, and this one involves cold hard cash. The source mentions a $1 billion capital raise that is ready to be deployed.
This is the war chest.
Now, this could be interpreted 2 ways. Is this a safety net because they're worried about a recession? Or is this ammo?
The source says it's for future acquisitions or expansion. I lean towards ammo.
Okay.
In a high interest rate environment, cash is king. A lot of smaller fintechs or even traditional financial services might be struggling right now. Their valuations are crushed.
Distressed assets. SoFi is circling like a shark.
In a way, SoFi is sitting there with $1 billion, profitable and growing. They are in a prime position to go shopping. They can acquire technology they don't have or buy a massive customer base to plug into their ecosystem.
So it's aggressive. It's not playing defense, it's playing offense.
And that is a key differentiator. While many legacy banks are tightening their belts, worrying about their commercial real estate portfolios, SoFi is looking at expansion.
But there are risks, right?
Yeah.
You have to be balanced. What could derail this train?
Absolutely. Regulation is always the biggest wild card in finance.
Sure.
If the government changes the rules on capital requirements, or if there is another pause on student loans, that hurts. And of course, if the economy falls off a cliff, people stop borrowing money. No bank is immune to a deep recession.
But the argument here is that SoFi is better positioned to handle that than the guys with all the empty buildings.
That is the thesis.
So bring it all back to that initial anxiety. The price is in the $19 range. The voting machine says, meh.
But we've looked at the weight.
We have.
Let's recap the scale. On one side, we have the fear and the volatility. On the other, we have record EBITDA of $318 million. We have a user base exploding to nearly 14 million.
We have institutional investors increasing their stakes by hundreds of millions of dollars.
And we see a structural cost advantage that the legacy giants can't match.
The source puts it pretty bluntly. Don't view it as a risk. View it as an opportunity.
The argument is that the fundamentals are currently disconnected from the price. The rubber band has been stretched too far, and usually over time, the price has to catch up to the execution.
The fundamentals are just too heavy to ignore. That's the takeaway here. It feels like the market is lagging behind the reality of what this company has become.
That is the core of the deep dive. If you believe the management can hit anywhere near that 40% growth target, the current volatility is just noise.
It's just the voting machine doing its thing.
Exactly.
So for everyone staring at their screens wondering if they missed the boat, maybe the boat is just fueling up.
A fair analogy.
Before we wrap up, I want to leave you with a thought. We talked about that billion-dollar war chest, and we talked about how SoFi is this lean digital machine without the baggage of physical branches.
Right.
So here is the provocative thought to take with you. With $1 billion ready to burn on acquisitions and a business model that is already profitable and scalable, what kind of acquisition could SoFi make that a legacy bank one weighed down by real estate and overhead simply can't afford to risk? Could they buy a legacy player's portfolio? Could they buy a major tech platform?
That is the billion-dollar question, literally.
Think about that. And hey, stop checking the ticker every 5 minutes. Go for a walk.
Bye-bye.
Thanks for diving in with us today. We'll catch you on the next one.